Great. Well, hello everyone, and welcome to this Edison interview between myself, Elliot Burstock at Edison Group, and Gervais Williams, Head of Equities at Premier Miton. Today is the 1st of April 2020, and I'm delighted to be joined by a renowned fund manager whose career has spanned over 30 plus years. I'm very excited to be discussing a number of topics, from the impact of coronavirus, the current downturn in the markets, and what the recovery might look like, but also what Gervais has been doing with his portfolio. Before we delve into all of that, firstly, Gervais, welcome. How are you, and how are you finding working from home in these rather unprecedented times?
Yes, it's kind of interesting, isn't it? When we say, how are you? We always used to do that years ago, and it was just a casual question. It's a little less casual now, but I think since you ask, I'm feeling very well. I hope you're well, and I hope your family are well as well.
Brilliant, thank you. And I guess at Premier Miton, you've been quite used to having video conference calls and setting up remotely as well, so it hasn't come as too much of an inconvenience.
It was interesting actually, because I mean, so much of what I used to do was actually face-to-face. I think you get a better conviction with face-to-face, but clearly having met all these directors in the past, we're very happy to do updates via video conference at the moment. But generally, yes, it's been actually surprisingly easy to slip into this kind of new world, isn't it?
Yeah, brilliant. Okay, well, for those listeners who might not be that familiar with Premier Miton and the funds that you manage, can you just briefly explain your investment approach for the two investment trusts that you manage at Premier Miton?
Yes, myself and Martin Turner, there's a team of two, run two investment trusts. There's the Diverse Income Trust. It's an income fund, as you might imagine. It's a UK equity income fund, i.e. we get the income from quoted shares where their dividends hopefully grow over time. The nature of that fund is it's not trying to keep up with the average in the sector. It's not trying to slightly outcompete some of the better ones in the industry. What it's really trying to do is just grow its income faster than most of other funds. If we're successful in that in the longer term, then we think that will come through not just in good income growth for shareholders, but most particularly also for better capital appreciation due to the dividend growth. Now, of course, Mini, the Microcap Trust, the Miton Microcap Trust, is a fund which invests in small quoted companies, hence its name. Specifically, it invests often in companies which aren't generating much income at the moment, but are investing hard in the same way that some of the companies in the Diverse Income Trust are investing to generate a stream of cash payback. And we hope as that comes through, a lot of the overlooked valuations of the smallest quoted companies will actually not just appreciate because they're successful, but appreciate perhaps from a lower level to much greater degree. And so we believe this fund in the longer term also has very exciting prospects, but principally from capital appreciation rather than dividends.
Great. And a large part of your job, Gervais, is meeting management teams from UK businesses. I think everybody's been extremely conscious of how busy they've been in recent weeks. How close have you been to the management teams of your shareholdings?
It's kind of interesting. I mean, I always thought that we are fairly closely involved. Yes, we meet loads of companies. Quite a lot we don't hold shares in. Quite a lot we do. What's been interesting is we've always had a very good two-way relationship. You know, we don't know everything, they don't know everything, but we've got a perception of how the market looks at things. They've got a perception of how the industry looks at things. If we put both of those together, hopefully we can actually craft a business which is more successful as a result of that. Clearly, we're just part of the shareholders. We're not the only shareholders. And as a result of that, we do expect longer term for other investors to have other views. So we're not just giving companies instructions, but clearly many of our clients hold not just significant weightings, but often quite significant weightings of these companies, maybe 10 or even 15% in some cases. And so we do have very close relationships. Those relationships remain strong. If anything, with all this unsettled nature of the pandemic around the world, we've probably been even closer to our companies, often talking to them about how they should frame their conversations with investors, how they should frame their public discussions, and most particularly on dividend policy as well.
Perfect. And you touched on it there, this sort of elephant in the room, coronavirus. Many listeners will believe that we might be heading into a deeper recession than 2008, 2009, the financial crisis. What's your view? And looking back at your career, is there anything you can relate this situation to?
Yes, it's kind of interesting, isn't it? I mean, I think the depth of the recession in 2008 and 8 was actually very deep indeed. It was very severe and it's very deep. So I don't know if this recession will be deeper than the one we had in 2008. What I think may be the case is it's probably something which has a more lasting effect. We were lucky in 2008 and we could cut interest rates in the UK from 5 3/4 to 0.5%. This time round, we have cut interest rates from 3/4 to 0.1, but it hardly has the same effect. And though we might use more fiscal policies, and of course the government has been extraordinarily quick to put in a lot of fiscal policies which have been very helpful to bridge the gap during the period of sales shortfalls. But ultimately, we think that the effects of this are going to be much more lasting. If you remember back in 2008, really by about the end of 2009 or even 2010, actual attitudes in the market hadn't changed very much. We think this will have a much more profound change in the attitude of investors and companies in their attitudes going forward.
Yeah. And just looking at global equity indices, they're down sort of 25, 30% since the start of the year. I think the Footsie 100 touched 4,800 last week in the futures. How much bad news do you think has been priced in? And many people are talking about V recoveries, U-shaped recoveries, or even G. What's your opinion of how we'll come out of this?
Yes, it's going to be interesting. I mean, I think going into this downturn, I think equities had actually had a very good long period of outperformance, really, not continuously, but it felt a bit like continuously since 2008. So valuations going into the downturn were probably at the relatively elevated end of the range. On top of that, quite a lot of companies felt under pressure because of low interest rates, because of the growth of growth stocks and wanting to keep up with them, to actually not just distribute dividends, but distribute dividends at lower dividend covers. So I think going into the downturn, there's more risk in terms of dividend cuts as well as setbacks in the market overall. So I think actually the effects of this aren't necessarily going to be very short term. I think they'll be with us for some time, but most particularly, I think the nature of recovery will be quite patchy. I think we will get a recovery, of course we will, but it'll be quite slow. There'll be certain industries which do well. I think the more interesting thing is that actually quite a few companies which are badly positioned for the setback will lose out completely. I think quite a lot of them will have emergency rights issues. Some will have to sell various parts of their businesses for nothing or very low valuations, and other parts of them could possibly go bust. We've seen an example of that recently with Restaurant Group. So from that point of view, I think that the disadvantaged lose out more, but that does mean hopefully that the companies which are stronger will actually not just win, but actually win bigger than they would have done otherwise. So I think going forward, there'll be more differentiation in the stock market between the winners and the losers. And that's the opportunity for people like us and other active managers to add more value.
Yeah, sure. And you touched on interest rates being slashed and huge government stimulus plans. What sort of asset classes, sectors within equities do you think will perform well? And you know, you mentioned a stock pickers environment that's going to continue even more so of importance in this period.
Yes, it's kind of interesting, isn't it? I think the interesting areas which we think are still doing well are often companies which are online. So we're all working more from home. So anyone needing services from online companies is probably going to be seeing an increased demand. So there's quite a lot of technology companies which we think are going to do well. On top of that, we actually think as well, companies which actually have strong balance sheets will continue to succeed. And most particularly, we would also argue that companies which actually have a strong financial position in certain niche sectors are also going to do well because as some of their competitors fall over, they'll be able to hopefully take on market share with less competition. So there's quite a few areas we think are going to do well. Of course, the areas which are probably more challenged are consumer areas. We think consumer remains under pressure here. We think actually there may be more unemployment, unfortunately, as a result of this crisis. And so that's going to be quite a big issue. We think there'll be quite a few closures of various entertainment sector operations, perhaps restaurants and other things will be there. And we think that those companies, perhaps in the financial sector, which are overgeared, will also be at a disadvantage going forward.
That's great. That's a really helpful insight. And I suppose looking at the two trusts that you manage, what changes have you made in the portfolio? You talk about, you know, certain tech stocks doing well and consumer potentially having a period of weakness during this time. Can you give us some insight into any changes that you've made in the last sort of month?
Yeah, it's kind of interesting. I mean, going into the downturn, we were quite cautiously positioned. We tended to have higher margins of safety in most of our companies. The balance sheets were strong. The underlying value of these companies was really driven not by the growth of the economy at large, but by the growth of their individual sectors. Overall, we haven't had to make many changes. There are some companies where we've sold, for example, those involved in transport. So we've sold Go Ahead, for example. We've sold EasyJet. The case of these kind of companies is you need to sell them early. So we sold them quite early in the downturn, and that's been quite helpful. Companies coming into the portfolio, we brought in the odd new issue. It's very strange. Even in this market, in January, February, there were still some new issues coming to market. FRP Advisory is a company which is involved in the administration of companies which get into financial difficulties. Of course, that's an area which wasn't that buoyant in January, but maybe more buoyant in the February-March period after all of this. So we expect that company to do well. It was terrifically well positioned, nice valuation, good strong dividends, good strong balance sheet, which was good. The other thing, of course, we've done is we've sold our put option, which has brought more cash into the portfolio. And we've used that really for topping up some of our existing holdings where we think that some of the share prices got oversold.
Okay, interesting. So at what point did you sell the put option to I suppose, release some more cash for investment ideas?
Yes, what we've always said to investors is that generally we tend to buy put options when we think the valuations are ultra low. Now that for us means that volatility, a kind of measure of how wobbly the markets are, is very, very smooth. And that doesn't often happen, but it did happen in our case in the UK, in spite of the worries about Brexit and governments and all the other things, in April and May of last year. So we bought a put option for the fund. We extended the current put option at that stage to December 2020. So it's been decaying in value over the end of last year. It came into this year at about 1%. It tends to decay about 1% per year on average. Clearly, with the volatility of the markets rising, with the stock market itself coming down, it had an exercise price on the Footsie 100 at 6,300. So from that point of view, as the Footsie went down towards 6,300, it started rising in value. And as it went below 6,300, it actually rose considerably in value. And the volatility of markets rose to about 60, between 60 and 70 as it was in the 2008 crisis. And when people are that keen to buy volatility off us, we're very happy to sell. So we sold it about 2 or 3 weeks ago, just as the market was going down through 5.5, going down towards 5.2. We booked a very substantial profit, about 6 or 7% of the NAV return in the period since the start of this year has come from the put option.
Great, thank you. And
so that's on diverse income trust, I should say.
That's on diverse income trust, and many listeners might think that why is it a put option in the Footsie 100 when you're predominantly investing in lower market cap sizes? Is that to do with the cost of that option?
Well, the main thing you want with a put option is to actually make sure you can sell it in the middle of a crisis. Yeah. And the great advantage of the Footsie 100 put option is that it's a regular market instrument and there's a regular price all times, even in the most distressed circumstances. And that's when we really want to sell it. So from that point of view, it's lower cost in terms of its it decays in value less fast than some other instruments, but most particularly we can take very serious profits. I mean, coming back to Mini, actually even Mini held the Footsie 100 put option, not as much, a smaller position. It was only about 0.7 or 0.8 at the time of the turn of the year, but that obviously rose considerably in value too. That probably added about between 4 and 5% to the total return of the fund. But again, extra cash in a falling market, in a fund which actually has the opportunity to buy microcaps at ultra low valuations is a really lovely thing to have for the fund.
Yeah, no, definitely. And I'd say that's probably an unusual characteristic relative to a lot of other fund managers. Indeed, some fund managers might be tempted now to get a little bit of leverage. Is that something that you'd be looking at this point?
We've always said the great advantage of investment trusts is that we don't need leverage to make a good return. Longer term, we've actually made quite good returns for our investors in these strategies. Perhaps over the last 2 or 3 years with the advent of the Brexit debate, the uncertainty about the position of the UK government, worries about the nature of what Brexit would be and the moving dates of Brexit exit, there has been quite a lot of anxiety. Valuations at the smaller end of the market probably haven't risen as much as the rest of the stock market. Clearly with the big pandemic, valuations of everything have moved down, big and small. So we've got some really fabulous entry points to some of these stocks going forward. But coming back to leverage, we said we don't need leverage. The only time we use leverage is after the bottom, not at the bottom, but after the bottom. So going back to 2008, in 2009, when we saw not only interest rate cuts, but the introduction of quantitative easing and the shock and awe of that, and also the largesse in terms of fiscal policy by the UK government, as the risk-reward ratio on the upside became particularly attractive, that's the time to put debt into the business of the investment trusts. We don't see those signals yet. It's in reserve. If we do see those signals in future, we will go to the board and ask for their permission to gear up the fund by between 10 and 15%.
Great. And you touched upon some of the advantages of being in a closed-end structure. Just focusing on diverse income trust, what sort of revenue reserves have you built up over the years? And is there a buyback policy, a redemption feature that you use?
So the trust has built up a reserve. It had 0 reserves when it was first issued in 2011. Over the years, quite a few of the companies we've held in the portfolio paid special dividends. In general, the ordinary dividends have been distributed to shareholders and the special dividends have been retained in reserves. And over the period since we first set up the trust, it now has a little over a year's reserves. So in other words, it can pay a whole year's dividends out of its reserves if that's what it chose to do, if there was no further income. Clearly, with this gives the fund the opportunity to continue to smooth dividends for shareholders in the longer term. But most particularly going forward, we think actually the company itself actually has got to continue to back companies which don't just sustain dividend, but continue to grow dividends. There are quite a few which are cutting dividends at the moment, including some in our fund that may hold back revenue growth in the very short term. But as long as we've got the right companies which can continue to actually not just have strong balance sheets, but can make up these dividends in the future and grow their dividends in the longer term, then we think that's the key advantage of the trust. And we think that opportunity of buying those type of companies across a slightly wider opportunity set of the multi-cap approach means that actually the diverse income continues to have good prospects.
Great. And you touched upon a lot of companies cutting their dividend, a lot of investment trusts using a scrip dividend. Diverse income trust currently yields over 5%. Can you give us some security that dividend should be relatively safe at diverse income trust?
Yes, I mean, obviously dividends and dividend payments are the discretion of the directors. We'll have to see what the directors feel about this. They'll make the final choice. But before them, they have the ability to continue to pay the dividends as previously, if that's what they choose to do. And in time, they can possibly even grow them in time if that's what they think to do. But most particularly, the whole nature of investment trusts with reserves should actually have a smoother dividend profile than perhaps the unitized vehicles, the OEICs, because they tend to pay out all of their earnings, all of their dividends simultaneously. And when they get a downturn in their dividends, then you see a downturn in the dividends of the OEICs as well. So the whole point about investment trusts is they have a smoother dividend flow, and that will be for the director to determine as to how that should be applied.
Great, thank you. And just for our listeners, I suppose as well, can you give us 2 examples of stocks that you've bought recently that really illustrate your investment approach?
Yes, I mean, we've had one in the portfolio which we've been topping up on. So Inspired Energy is a company which helps large companies and small companies actually monitor their energy consumption and minimize it. So if a company with a number of different sites leaves their factories lights on one night, or perhaps leaves the heating on in a retail outlet overnight, they will monitor that. They will bring that to the attention of the local manager. They'll ask for them not to do that again. And clearly, there's an element there which means that if they keep doing it, then longer term, the management will be made aware, and hopefully that'll stop. So it's a way of just reducing cost, making sure that companies are managed efficiently. They don't the good practices spread across a number of sites. Now, what they've done over recent years is they've made a series of acquisitions which extends their operations from just monitoring and measuring the use of power and water and such like, to actually helping companies with their green CO2 certificates. Going forward, the focus on climate change will mean many companies are going to have to not just worry about their CO2 emissions, but how they manage it and how they reduce it in time. And this company, Inspired Energy, is actually superbly positioned to do this. It's got a very attractive yield. The share price has come down for reasons we can only assume are related to the stock market overall. We've been very, very happy to add to that company on a sub 10 PE ratio in the past. Clearly, we'll have to see what the forecasts do going forward. Another example is we brought new companies into the portfolio. One of the things is, again, you often find companies which have had a setback along the way, are overlooked, and the share prices fall too far. We think this has been very much the case perhaps for some of the spread betting companies. They have been long-term suppliers of gaming, really, if you want to game on whether the oil price is going to go up or down. Quite a lot of people use those. They came under pressure from the FCA to amend their processes to be very much more rigorous on vetting new clients, to make sure that when people bought a spread bet on the oil price, that it wasn't 50 times geared, it was only 30 times geared. And this led to actually a consolidation of the sector. Many of their competitors moved out the industry, particularly those which were less well controlled. And the companies which are quoted, which tend to be the better quality companies, have actually taken market share. Over recent months, of course, we've seen, with the volatility of markets, people have been actually buying and selling all sorts of spread bets at a much higher level of activity. So the companies came from a low valuation about a year ago when we bought them, and they've been trading not just well, but extremely well over recent months. We've had a lot of above expectation trading statements. And I think that just underlines the nature of the portfolio. We like to buy companies where quite a lot of the correlations, the kind of conditions which they trade well in, aren't always just correlated with stock markets. At the moment, as stock markets fall, some of these spread bettors are doing better, and they're having better dividends and growing dividends going forward. So those are two examples of the kind of areas which we've been adding to for the portfolio.
Fantastic. And touching on spread bettors, I assume you're talking about the CMC markets and IG indexes of the world. And I guess, what's your horizon when you look to invest in those companies? Obviously, you have a filter and a criteria that you look at, but sort of what's your investment horizon?
Yes, I mean, if you look at the spread bettors, it does include CMC and indeed IG Group, and it does actually include plus 500 as well, which is also another company which has been successful in this area. And coming back to it, of course, we have all three. They have slightly different operations, slightly different risk-reward ratios, and of course the risk is spread across the three different holdings there. Coming back to the time period, of course, we tend to look over the next 2 or 3 years. To be honest, it's quite difficult to look more than 2 or 3 years ahead. Look at the last 2 or 3 years with Brexit and the uncertainties together with the pandemic. Things can change so fast that any longer time period, you really haven't got a chance. So we tend to look over the next 2 or 3 years, cash in for cash out. How much are you investing? When's the cash going to come out? What are the risks, not just in terms of balance sheet, but also reputational risk? How well are you managing those risks? Specifically now with climate change, are you worrying about reputational change? Can you do better than others in terms of reporting and addressing CO2? So from all of these things are come into minimizing risk and maximizing return. And that's the nature of what we're trying to do, not just in diverse income, but also the Miton Microcap Trust.
Brilliant. And looking at the likes of Inspired Energy, sub 100 mil market cap, how much of an issue is liquidity when investing in the microcap space? And is there anything that you can do to mitigate the liquidity of some of these stocks?
Yes, you're absolutely right. I mean, being small quoted companies, of course, they don't trade so often. It takes a longer time to buy them. It takes a little longer time to sell them. The way we really manage it is actually we buy lots of them. So coming back to CMC and such like, it's not below 100 million market cap, but many of these companies, if you buy more than one of them, of course, then you can sell more of one of them simultaneously as well. So it means that actually you've got more opportunity to actively deal in a number of these companies simultaneously. So the reason for that is therefore we tend to have a bit over 120 holdings in both of these portfolios. It means that actually many of the companies we hold, we have small weightings in the portfolio. So if we need to increase them or need to decrease them, we can do so with the liquidity at hand. So it's about managing the risks and making sure we buy companies with safe balance sheets. We don't need to rush the sales. It can take a while. That's not a problem. But in the context of the overall portfolio, it means that actually we've just got a mix of different risks, and we are able to deal in many of these microcaps. What's interesting about, particularly since the election of the UK government, the fact that we've got a safe long-term government in the UK, business-friendly government, has improved liquidity at the bottom end of the market. We've seen that improve. And with the recent market setback and the pandemic, clearly share prices have been moving a lot, and that too actually tends to increase liquidity. So liquidity at the moment has actually improved rather than reduced.
So Gervais, you've touched on the put option, which has released some cash into Diverse Income Trust. What is the general cash position? We're in a period where a lot of companies have employed everything they can to keep cash in their businesses. How much firepower do you have currently?
So we went into the downturn with a precautionary cash balance anyway. I've talked a little bit about some of the sales we've made from the portfolios. as the market peaked out and came down. So we sold a couple of things early on. So that brought in more cash. We've had the odd bid in the portfolios since the beginning of the year as well. So that's meant actually with the put options, cash balances have moved up quite nicely. I mentioned we've actually bought a little bit of new holdings here and there. So the cash balances in the diverse income trust are around 10% currently as we speak. And if we look at the Microcap trust, the Miton Microcap trust at the moment, it's about 10.8%. You might say, are we rushing to put that in? Not at all. We've actually got plenty of time on our side. There's lots of companies which are mispriced. There's plenty of opportunities for us to identify them, make sure that the risk-reward ratio is beautiful, and then buy them and hopefully fully participate in their upside when it comes.
Fantastic. And Gervais, you've got an excellent long-term track record. Looking at the period of 08 and 09, did you change your investment process significantly and make advantages of the opportunities that were available at the time?
Yes, it's interesting. Actually, going into 2008, 2009, we had a very cautious portfolio. Again, we had a put option in the growth trust I was running at the time, which enhanced returns. What was interesting about 2009 wasn't just that we had the recovery, but actually a lot of companies didn't go bust because the banks couldn't put them into receivership. So what was interesting is actually some of the best returns after 2009 were in very highly geared companies which were doing rights issues. So in that case, we really did need to change our portfolio. We needed to get involved in a lot of companies which had been fallen angels with lots of recovery. This time round, we don't think that's the case. As I touched on earlier, we think that actually some of the companies with stretched balance sheets are going to find things extremely difficult going forward. We think if anything, they are losers relative to those companies which have strong balance sheets. So going forward, we think we don't need to change our portfolio. We need to keep it the same, which is contrast with what we did after 2008.
Great. And looking at the closed-end structures, diverse income trust and microcap, they're trading at substantial discounts. I think diverse income trust is just over a 10% discount to NAV. Historically, how does this valuation compare to other times? And I suppose just finalizing, is there any comfort that you can give shareholders of these two trusts that have seen the value of their investments fall?
Yes, I mean, it's interesting, isn't it? I mean, if you look at the long-term prospects of these companies, we would argue they're pretty strong. But most particularly, the nature of these funds are that the NAV sometimes does better than the share prices. And for that reason, you get the discount opening up. So how do we deal with that? Well, the first thing we do is we allow investors to buy and sell in the stock market. If the price isn't very good, we give all investors an opportunity at the discretion of the directors to redeem their holdings. The reason for that is to make sure that if there are overhanging sellers, they are cleared. And if you clear the overhanging sellers, it means new investors know there's no overhanging sellers. And as they buy, that drives the share price back up to the NAV. So both of these trusts have actually had NAVs which have been quite close, share prices quite close to their NAVs over the life of their trusts. That said, there are times when they're a little out of fashion, they do tend to go into discounts. The Microcap Trust has actually had a period where share prices fell last year when the market was rising. It was out of fashion. Discount opened up a little bit. But what's happened this year is actually the share prices on our funds, though they've gone down, have actually surprised versus other small cap investment trusts on the upside. So we've done too well in the NAV and the share price hasn't quite kept up. And we'd like to see that close in due course. So our job really as fund managers is to keep that NAV hopefully doing better than most others, keep it hopefully if the markets are rising faster than most other funds, and then there'll be an opportunity for other people to buy the investment trusts and see that recovery in the share price. Clearly the boards both have opportunities to buy back shares. They do, they can exhibit this opportunity on a day-by-day basis. They rarely get involved where there's other buyers active in the market. If there's other people wanting to buy, let them finish. But if they run out of buyers, then the board can always look at buying some more shares themselves. They have done that occasionally in the past, and that's there for them to do. But the ultimate mechanism is the redemption each year.
Fantastic. Well, that concludes our interview. Gervais, just want to say thank you very much for your time and continued communications to shareholders and investors. Gervais Williams, Premier Miton, thank you.
Thank you very much indeed, Elliot. That has been very helpful.